This is the Asia Train. I'm Shery in Tokyo.
I'm Avril in Singapore. Your top stories this hour. A strong lead-in for Asian stocks with a tech rebound driving Wall Street back towards all-time highs. Gold topping $5,000 as investors await readings on U.S. jobs and inflation. Alphabet goes on a bond spree to fund its massive AI spending plans, raising $20 billion from a dollar offering and pitching investors in Switzerland and the UK. Plus, a triumphant Sanae Takaichi promising to build trust with markets after her election landslide. But tensions with China prompt a warning from Beijing.
Yeah, Prime Minister Takaichi really acknowledging the concerns over how she plans to fund her sales tax cut on food for 2 years. She says that she will be seeking a report on that sales tax before the summer. You can see the Japanese yen holding at that 155 level, just a touch below 156, as we have seen a little bit of strength in the Japanese yen. And of course, Japanese stocks have rallied to a record high. Even the fall in JGBs was a little bit milder than was originally expected after that historic landslide victory by Prime Minister Takaichi, as we continue to await more details on her funding plans. We continue to watch the ASX 200 in the staggered open. We're seeing a little bit of gains, 0.6%. Do watch out the miners because gold has topped $5,000. We are seeing oil also gaining ground on tensions around Iran, and the offshore yuan holding at that 691 level. We're talking about the highest level against the US dollar since 2023. We have seen the dollar weaken, weighed down for about concerns on Chinese demand over US Treasuries. Avril.
Yeah, in terms of how U.S. assets fared overnight, we did see stocks rebounding, extending what we already saw on Friday. And this was led by tech. But interestingly, there was a lack of breadth. There was a lack of volume. So not quite there yet to some. And what we could be seeing is actually a bit of short covering, especially when you consider how the likes of Goldman say that hedge funds piled into short positions on U.S. stocks amid last week's rout, especially tech stocks. So they could be getting squeezed as stocks recover. And all this amid the massive spending and borrowing from Alphabet. Now, in terms of treasuries, we are seeing them edging higher ahead of crucial economic reports this week, the delayed U.S. jobs report and some inflation numbers as well. The NEC director, Kevin Hassett, indicating that the jobs market there, it could soften in the months ahead. So that could be another driver when it comes to treasuries. Let's get more with our senior editor for markets and Bloomberg opinion columnist, John Authers. John, I wonder what you make of the moves in the past week, especially when it comes to U.S. stocks and the tech rout now having rebounded, but lacking in breadth, lacking in volume. What are you seeing in terms of the drivers?
I wouldn't make too much of the rebound. I think we're definitely still in the process of a rotation. And as the overall markets, as you've said, are really not that bad at all. It's not necessarily an unhealthy rotation. You can see similarities to what's happened in 2000s, but it's happening with the overall markets much less negatively affected. But plainly, there is a belief that there is growth to be had out there and that there is still liquidity to be had out there. And that means that it's not so essential to be holding on to the biggest names that you're most confident in, that it becomes a safe time to start looking for bargains. And more or less anything you could care to mention is cheaper than the stuff that has been leading the market for the last 5 years, the Magnificent Seven. So I would still clearly say that the rotation continues, and there's still, I guess, some risk of an accident for somebody out there. But as it stands, I still see this as a healthy move in the right direction.
Healthy move in the right direction. So we have seen some concerns, though, over the overall appeal of U.S. assets in recent days, especially when it comes to treasuries, U.S. dollar, for example. And of course, it doesn't help when you get that rhetoric going. Will all of these foreign governments start dropping U.S. treasuries? And you got Bloomberg reporting that perhaps the Chinese might be thinking about that with their financial institutions. And it's it's true that their holdings have really decreased over the past few years, right? How much credence do you give to these concerns?
All right. I give a lot of credence to the notion that the US is going to have to be careful about exactly how much demand there is for Treasury debt. We have what's known as, from the French President Valéry Giscard d'Estaing referred to it as exorbitant privilege, which probably sounds better in French, that the US can get away with borrowing more because it has the reserve currency. I don't think the reserve currency status itself is in danger, as some people say, but it certainly means that there is certainly a sense in which people are more anxious, more concerned to look for alternatives. I think, frankly, the degree of interest in lending to Google suggests that people see that they would like some alternatives to US Treasuries. In terms of what China is doing, however, I mean, this was always a big, scary sort of conspiracy theory style scenario 15, 20 years ago, that they built up these holdings and then they'd use it as geopolitical leverage. I don't see it that way really at all, because you then hurt yourself if you're China, if you sell in a hurry. I think this is sensible management, and this is reasoning that will be occurring to lots of other people that will be holding treasuries. It doesn't necessarily mean fiscal crisis. It does mean that the US government has to be very careful about the way it manages its debt.
And John, before I let you go, let me turn to Japanese government bonds, because, of course, we saw that landslide victory. The dichotomy that we're seeing in the Japanese economy right now, when you're seeing this sell-off in Japanese bonds in the yen, but this immense rally in stocks, how risky is this position?
Well, people often ask to make comparisons with a couple of famous British female prime ministers. I still think Senator Takaichi is very much more Margaret
thinking
Thatcher
of Liz
than
Truss
Liz
at this point.
Yes, thankfully for Japan, I think this is this still looks much more like a Thatcher comparison than a Truss one. If you look at the yen, I think is the reason for comfort so far. Early days yet, but we haven't seen any major further pressure downwards on the yen, and and bond yields are holding a little below the peaks they got to a few weeks ago. Takaichi, I think that the strength of the mandate basically means that one person has quite a lot of control over this, and that will make it far easier for the authorities to be nimble if you really do get some kind of a fiscal crisis brewing. So although people are nervous about her being as much as fiscally expansive as she is, there is something very reassuring, given the amount of inertia, the amount of bureaucracy that goes on in Japan, that one person so clearly is holding the baby, that the buck so clearly stops with Takaichi, that there is more confidence that serious problems, that a crisis can be averted. So so far, so good, I think it's fair to say.
Yeah, I mean, the market resilience was pretty incredible yesterday. John Arthur, it's good to see you. Our senior editor for markets and Bloomberg opinion columnist there. We continue to watch U.S. tech stocks, as we've been discussing, because we continue to see that rally after the massive sell-off just a few days ago. We're talking about this rally that has led to the surge of $1 trillion to the S&P value just at the end of last week. Of course, we started with that software stock sell-off and then turned around, and we are now seeing a little bit more optimism that perhaps these software makers might see some demand from really these tech giants ramping up CapEx spending. The likes of Oracle, for example, is down about 50% from its September highs, but we have seen it extend its rebound on the Monday Wall Street session as well. And we continue to see all of this spending. And how are these giants financing it? Well, Google's parent company, Alphabet, going on a global bond spree, raising $20 billion to fuel this unprecedented spending plan behind its AI push. Let's go to San Francisco and tech reporter Brody Ford. Brody, this seems to be pretty interesting because they're reaching out to investors in Switzerland, in the UK, and even thinking about a 100-year bond.
That 100-year bond is pretty eye-catching, right? I mean, anybody who's taken that out is not going to be around when it comes due. But it underscores this moment we're in where every single big tech company is on the hook to deliver some really big data centers because they are thinking that we're in this kind of once-in-a-generation spending cycle as it relates to AI, and they don't want to get left behind. So whether it's Google, Microsoft, Amazon, Meta, they're all kind of trying to outdo each other with their big spending plans, and generally that money has to come from somewhere, and the bond market has emerged as a pretty cool way to go and pick up a couple new $10-20 billion.
Brody, we are seeing in terms of Oracle stock that support thanks to all these big spending plans. How much has the concerns around software been eased since last week?
Yeah, I mean, Oracle had been beaten up more than anybody, right? There was a moment in September where they had a moment of euphoria where everybody said, wow, this OpenAI contract is going to deliver them to becoming the fourth major hyperscaler. And then after a little while, it became maybe working with OpenAI is a big liability because are they actually going to pay their bills? The last couple of days, we've seen some more optimism come back because OpenAI looks like they're going to fundraise a bunch of money, and all the hyperscalers are showing that demand for compute is currently insatiable. So if you're a company like Oracle right now who is orienting your entire company around offering AI compute, it's looking a little rosier than it did a couple of days ago.
Brody, a lot of these themes around tech right now sound very, very circular, whether we're talking about financing or just how the stocks are moving right now. We're saying that Oracle is gaining because hyperscalers will spend more, and then you have Microsoft being downgraded again.
Exactly. Yeah. So a really important distinction in the market right now is the infrastructure versus applications. A lot of the anxieties around the applications, right? The companies like, Microsoft making Word or PowerPoint or Salesforce making CRM systems that the fear is could be ripped out and replaced by more lightweight AI competitors. That's not something we've really seen play out yet. It's a pretty speculative fear, but every time one of these frontier model companies releases a tool that looks like it could whip up an application without a whole lot of work, it makes investors wonder that are CIOs really going to keep increasing the amount of money they give Microsoft 10-20% every year? Microsoft in particular is offering Copilot, which is kind of its signature AI tool. Think about it like a more buttoned up version of ChatGPT. Essentially, the results there have just been a bit underwhelming. I think the uptake of a lot of these AI tools is just slower than a lot of the boosters would suggest. And so it's not a great time to be pitching yourself as a traditional application company.
Brody, great to get your insights. Thanks so much. Bloomberg's Brody Ford in San Francisco. Now, still to come on the Asia trade, UK Prime Minister Keir Starmer shores up support from his Labour Party, but his reprieve may only be temporary. More on his precarious political position next. This is Bloomberg.
We're talking about responsible, proactive fiscal policy, but the responsible part is crucial. Our policy is to secure market confidence by ensuring fiscal sustainability, by steadily reducing the debt-to-GDP ratio.
Japanese Prime Minister Sanae Takaichi speaking in her first press briefing since her party's landslide election win. Let's bring in our senior editor, Brian Fowler, for more on this. She seems to acknowledge that there are concerns out there about her fiscal plans.
Yeah, so she stressed pretty much right from the start that she wants to keep in close contact with financial markets. Really, that's the one thing. I mean, with all the support she had from the voters, the biggest election win in history for post-war Japan, she's not worried about politics so much as how the markets take take it in. And we saw probably the best reaction you could have hoped for yesterday in getting the stock rally without too many ructions in the currency and bonds. And now she wants to make sure that she can somehow walk that tightrope between keeping equities supported but without undermining the equities, the bond market and the currency.
It's really interesting because we heard from some analysts, because of how big her mandate is, that she can actually maneuver around some of these risks.
Yeah, so I mean, she's really in a position where she's not desperate by any means, and so she can take her time. And she can bring in the opposition parties as well, which is a very shrewd thing to do, even though she has this mandate. I think she wants to try to, forge cooperation with all the parties. And so, for example, the suspension of the sales tax on food, that was something we were looking at during the campaign period. She's still talking about doing that, but she's going to take her time. She wants to get a thorough report on what that might look like, including what the funding sources might be, by the summer. And I think that also gives her time to bring the opposition parties in line on that, so she can get kind of a broad support base for that.
Does she have more time and also perhaps more confidence on the world stage, especially given heightened tensions with China? Take a listen to what the Chinese Foreign Ministry had to say about her win.
The election is the internal affair of Japan, but this election reflected some deep-seated and structural issues as well as certain emerging views, trends, and developments, which deserve serious examination by people with insights in Japan and the international community. The lessons of history are still fresh in memory and should not be left behind. We urge those running the Japanese government to take seriously, rather than brush aside, the concerns of the international community.
The tone seems to be pretty firm, and Beijing doesn't seem like they're backing down.
Yeah, I would say it's a very tepid response that contrasts very sharply with what we heard from Donald Trump. For China, it's a little bit of a slap in the face. I mean, they had this ongoing issue with Takaichi, and then she comes out the most popular, biggest win in history. So I think China was caught a little bit off guard. She's come out and said, okay, well, she's going to continue to talk to China at various levels. She wants to work towards some kind of agreement. But there's no way, I think, that she's going to hold out an olive branch and say, she's taking back what she said about Taiwan, and she doesn't have to. And, the signals she's getting from abroad as well. I mean, the U.S., Donald Trump specifically said peace through strength is something he wants to see, and I think she agrees with that. And she's talked about building up defense with that in mind.
Bloomberg senior editor Brian Fowler here with us, as we will be watching also Prime Minister Takaichi's visit to the White House March 19th, Avril.
Yeah, turning now to politics out of the UK. Prime Minister Keir Starmer has received a show of support from cabinet members after the Labour Party's leader in Scotland urged him to quit. He's been under pressure for appointing Peter Mandelson as ambassador to Washington after disclosures about Mandelson's past links to Jeffrey Epstein. Let's bring in Bloomberg's Rosalind Matheson. So, Ross, we're seeing cabinet members rallying behind him, buying Starmer some time, but how much support does he really have?
Well, that remains the big question. You did see Cabinet coming out quite strongly behind him. You've also seen some of the Labour Party faithful coming out, aside from the Scottish Labour Party leader, who came out publicly and said that he thought that Starmer should resign. And obviously that buys him a little bit of time. We've talked about the fact that they've got local elections coming up in May. That's likely to be a key barometer. If Labour performs especially poorly in those elections, this noise, about Starmer is just going to pick up again. So maybe these leaders, these potential challengers, want to wait and see how those elections go. Starmer takes the heat for that performance, and then they sweep in. But there's a lot of kind of wrangle conversation going on inside Labour at the moment. On the one hand, we're only, 18, 19 months from a massive win for Labour. Do you change leaders now? Does that look like, you're chaotic, a reminder of the changing leadership we saw in the Tory years over and over again? But you can't leave it too late, because if you get too close to election, you don't leave time for a new leader to really put their mark on the leadership and try and change the popularity of the Labour Party. So there's a lot of contortions going on behind the scenes in the party, but it does seem at least he's bought a little bit of time, but those elections in May are going to be key.
To your point about what's going on in the background, I don't want to jump the gun here, but what are the political alternatives potentially to Starmer?
Well, we know there's some of them who are probably already readying their campaigns, and one of them is Wes Streeting, of course, the health secretary. Has been very public about his disquiet about Starmer, and he, interestingly, was not out very publicly supporting Starmer overnight. On this furor over Peter Mandelson. I mean, Wes Streeting has his own friendship with Mandelson, so perhaps he wants to clear some of that baggage before potentially mounting a challenge. But the one really to watch also is Angela Rayner, of course, who, was Deputy Prime Minister. She's got her own issues, her own baggage, which is around her tax affairs. So perhaps she wants to sort that out before she mounts a challenge. But there are a number of people who probably have maybe enough support within the parliamentary ranks to think about a parliamentary challenge, possibly again after May. But the main ones to watch are Wes Streeting and Angela Rayner.
And all this is proving a distraction to the more pressing issues of curbing inflation or driving the economy. How are things progressing on that front?
Well, that's right, because, of course, the Starmer government's had a couple of missteps. They're in a very, very tight fiscal position. There's very little money to spend, but a lot of pressure to spend on things like the National Health Service, which is crumbling, on infrastructure, which is challenged, moving the economy more towards generating income from AI, attracting business from overseas, all those kind of fundamental challenges. And, of course, they've had missteps on, public benefits. They've had to change policies very quickly. So the sense is, Wes Streeting has said this in his private messages to Peter Mandelson. He said, we don't have a strategy around growth for Labor. Where is Labor going? And the sense that they're a little bit adrift in their policies. And so, this aside, Starmer really needs to try and get his messaging back on track. Again, massive win 18, 19 months ago, and the sense that his government's been drifting ever since.
Yeah, have to deliver those results. Ross, great to have you. Thank you so much. Bloomberg's Rosalind Matheson. Some other global headlines we're following. Bank of France Governor Francois Villeroy has announced he'll step down in June, well before his term was due to end in October 2027. Villeroy says the decision was personal. It clears the way for President Emmanuel Macron to appoint his successor rather than leaving the choice to a future administration. A White House official says the exact date in April for President Trump to meet with Chinese leader Xi Jinping has not yet been finalized. That's after Politico reported Trump would head to Beijing to meet Xi in the first week of April. The two leaders could potentially meet 4 times this year as their truce over trade holds. U.S. Secretary of State Marco Rubio has criticized the 20-year prison sentence for former Hong Kong media mogul Jimmy Lai. Rubio described the court decision as unjust and tragic and called for Hong Kong to grant Lai humanitarian parole. The 78-year-old was convicted of multiple breaches of the city's Beijing-imposed security laws, as well as British colonial-era sedition legislation. We have more ahead on the Asia trade. This is Bloomberg.
The U.S. is warning American flagged ships to stay as far as possible from Iranian waters when navigating the Strait of Hormuz. In a maritime advisory, the U.S. says Iranian forces have attempted to force commercial vessels into their territorial waters as recently as February 3rd. The warning comes after diplomatic talks in Oman, described by both sides as positive. So we had a little bit of a bump in oil prices given the tensions around Iran, but prices actually fell last week on signs of progress between Iran and the U.S. We will be watching those flows as we continue to look ahead to a supply glut this year.
We have breaking data out of Australia. Consumer confidence falling yet again by 2.6% on month, this time to 90.5. This marks 3 straight months of a decline in consumer confidence from the Westpac survey. So pessimism outweighing the optimism yet again, deepening gloom in consumer confidence down under, and all this against the backdrop of the RBA hiking earlier this month. For the moment, though, we are seeing stocks doing fairly well. The Aussie dollar is pulling back a little, but don't forget, it did hit those multi-year highs recently. Shery?
Yeah, it's been interesting to see the action in the Aussie, right? Pretty supported, as you said, 3-year highs, and we're still staying at around that 70 US cents level. Take a look at some other currencies. The Japanese yen, a little bit weak against the US dollar. We had seen a little bit of strength in the previous session after the landslide victory of Prime Minister Takaichi and her ruling Liberal Democratic Party. Interesting, the yuan, keep an eye, because 2023 highs against the greenback. We have seen concerns over China's demand for US Treasuries. That weighed on the greenback. That came from a Bloomberg report. The Chinese regulators have advised financial institutions to rein in their holdings of U.S. Treasuries, but really bringing to light the deeper and broader question that we're seeing this global trend of the likes of India, of the likes of other countries also sort of pulling back from their exposures to U.S. assets. What's happening to the appeal of the greenback itself? Take a listen to what the Fed's Avril Bostic had to say.
I was in Europe last summer, and people were asking, like, can we still trust? Like, what should we know, and how should we think about where things are? Those are the sorts of things that will create rippling in the valuation of the dollar above and beyond what happens in specific markets. And we will have to, well, hopefully we don't lose that. I think it's been good for the U.S. to be the fiat currency for the globe.
Joining us now is Carie, global market strategist at DVS. Carie, really good to have you with us. We continue to see the pressure on the dollar. We're talking about 1% losses in the past 2 trading days alone. Where are we in these conversations and debate around the dollar debasement trade?
Yeah, I think over the past 2 sessions, the decline in the U.S. dollar actually was driven mainly by the resumption of this debasement trade. But in the short term, on the tactical horizon, actually, we think the dollar index may still find some support around 95 to 96. Because first of all, we've seen the latest data like ISM manufacturing and services index actually point to a still resilient U.S. economy. And then last night we've also seen the quite resilient U.S. stock market. And because of the still solid equity market and economy, it feels like the Federal Reserve itself may not be as dovish as expected. If this is the case, then the yield advantage itself may also help to support the U.S. dollar around the 95 to 96 level at this moment.
How closely are you watching who becomes the next chair of the Federal Reserve? We just got the latest comments from Kevin Warsh talking about how he wanted to transform the institution.
Well, for the upcoming Fed chair, actually, we think he is going to still protect the U.S., the Federal Reserve's independence, which is actually not a negative factor for the U.S. dollar. But however, at the end of the day, we've seen in the longer term, the U.S. dollar itself may still have a structural moderate downtrend, which has already formed since 2022, the start of Russia-Ukraine war, because this is not about the next Fed chair, but more about the U.S. policy uncertainty actually shakes the U.S.-led world order. And the market is also still concerned about the U.S. fiscal sustainability in the long term, which probably the reason why we will see this on and off debasement trade still weighing down the U.S. dollar in the longer term.
Carie, talk to us about the other side of the dollar trade in Asia, specifically for the renminbi. We saw a bit of firmness following Bloomberg reports that China has told financial institutions or banks to reduce their exposure to treasuries. And this is not because of geopolitical maneuverings, to be clear, but more because of paring back some of the risk in markets. As investors rethink what the U.S. assets are going to look like this year, what are you seeing in China?
Well, in China, we've seen the PBOC always talk about renminbi internationalization, and they also try to transform the economy towards a growth, consumption-driven growth model. And this probably needs the renminbi to strengthen a fair bit. And in the meantime, we've also seen quite a fair bit of capital inflows as well as a record high current account surplus, all supporting the yuan. And more importantly, the PBOC has set the dollar CNY daily fixing rate lower and lower gradually. Firstly, below the 7 mark and now towards the 6.95 level. It feels like the PBOC does allow some further strength in the renminbi. And if we look at the renminbi index, actually it's still below its 5-year average, which means that the catch-up play for the renminbi still has some room to run. So we do expect the dollar CNY to fall a fair bit towards the 6.9 level. And then for the next step, whether it will go to 6.8 or even 6.7, it depends on the next move of the US dollar. If the dollar index is trending lower towards 94, and if there is signs that the China's economy is improving further, then it's possible for the dollar CNH or dollar CNY to try lower towards 6.8 or even 6.7 in the rest of this year.
Carie, what about dollar Japanese yen? Is the verbal intervention we've been getting of late going to be enough to keep things down?
Well, actually, I think the yen's strength over the past session is a bit surprising, but it's mainly driven by the retracement in the US dollar as well as the verbal intervention. I think the market probably is still concerned about another round of coordinated rate check by the US and Japan. But as long as there is only verbal intervention and there is no real intervention, then probably the market's focus will shift back towards the concerns about the fiscal sustainability under Takaichi government. If that is the case, then probably the Japanese yen is not yet out of the wood. The dollar yen will still find some support around 154.5 before 152, and then the risk is still tilted towards the upside, probably towards the previous high around 159.45.
Yeah, that was achieved around mid-January, right? That 2024 low against the greenback. What are we expecting in terms of the Bank of Japan? Could we see accelerated rate hikes given the weakness in the yen?
Well, in terms of BOJ, actually, our expectation is for them to hike once more this year towards 1%. But there is also scope for them to hike further in the later part of this year or the early 2027 if the Takaichi government's upcoming fiscal expansion is going to support the economy and support the wage growth. And if that is the case, then probably for Japanese yen, they may also find some scope for further interest rate hikes.
Carie Lee, good to have you with us, global market strategist at DBS. Let's stay with currencies because IMF Managing Director Kristalina Georgieva has also downplayed the dollar's decline over the past year. Speaking to Bloomberg at an emerging market conference in Saudi Arabia, Georgieva said the U.S. currency should retain its preeminent position.
We should not get carried away by short-term variations of the exchange rate of the dollar, and we should look closely as to why the dollar plays such an important role in the international monetary system. First, over time, we have seen the dollar going up and down, and actually the dollar being somewhat down now is good for many emerging markets. Those that borrow in dollars now have to pay a bit less. But also what we know is that the reason the dollar plays such an important role is the depth and liquidity of capital markets in the United States, the size of the economy, the entrepreneurial spirit of the U.S. So I don't see a change in the role of the dollar in any time soon.
Okay, so you don't see that changing anytime soon. The other, I was just watching the panel now with His Excellency Mr. Jadran, and he mentioned that markets can be brutal, particularly when it comes to economy spending plans and fiscal and rebuilding fiscal buffers is another big narrative that has emerged out of this conference. Do you think that countries are taking this seriously enough, especially when, again, investors are tending to punish countries that seem to be overborrowing right now?
Well, countries better take it seriously. What has happened over the last couple of years is COVID, the war in Ukraine, they all led to government spending more to support businesses and households, rightly so, at that time. But what is the result? Fiscal buffers almost everywhere are depleted, and shocks are still to come. Therefore, what we say to everybody, to advanced economies, to emerging markets and developing economies, is now is somewhat better time. We have seen the world economy quite resilient to these shocks. Please concentrate on rebuilding these buffers. You need to have a medium-term prospect for how your fiscal position can be strengthened to withstand the shocks that inevitably will come. How are governments doing? Some better than others. And I can tell you where I am particularly concerned is for vulnerable middle-income, low-income countries that are particularly stretched today. So what we want is not only for them to do the right thing, but also for the world to be mindful of these countries. We have seen development assistance going down. Well, we have a responsibility for stability and security in the world. Help these countries.
IMF Managing Director Kristalina Georgieva speaking with our colleague Jumana Basechi in Saudi Arabia. And you can explore live streaming, news and interviews, as well as Bloomberg TV shows, documentaries, reporter analysis and more in one place. Check it out at bloomberg.com/videos. More ahead on the Asia trade. This is Bloomberg.
We'll be watching tech stocks across the market opens here in Asia after that rally in the sector continued in the overnight session. We're also hearing from the Financial Times that the Trump administration intends to spare companies like Amazon, Google and Microsoft from tariffs on chips. The Commerce Department planning to provide U.S. hyperscalers with tariff carve-outs, which would be tied to investment commitments made by TSMC, according to people speaking to the Financial Times. Of course, in January, the White House said that it intended to impose significant duties on chip importers, but we have seen the Trump administration also trying to help U.S. manufacturing and really not hinder this AI-related space. So we'll be watching those chip makers across Asia session as well. And of course, we continue to contend with the surge in memory chip prices as well over the past few months. This has opened a vast divide between winners and losers in the stock market. Asia equities reporter Winnie Su joins us now from Hong Kong. Winnie, how is this playing out in the markets?
Yeah, in the past few months, we've really seen that divergence in performance between the two baskets of stocks. Basically, on one hand, you have these users of memory chips, and it's a very wide range, going from gaming stocks to PCs, smartphone makers, and the suppliers of these, and even EV stocks, and also some of these related names. And these are actually really struggling in terms of their performances. While on the other hand, these memory chip makers soaring to fresh highs. We're talking about a gauge of global consumer electronics down some 13% in the past few months, about 4 months, while the gauge for memory chip stocks was up about 160%. And that gap is only widening as we enter this earnings season, and seeing that companies that really reveal the struggle of their memory chip crunch getting punished by with their stock prices. That's very clear when it comes to Nintendo, Nintendo falling over 10%, and also Qualcomm as well. Sony did have some positive earnings, but actually it raised all of its gains when it comes to the daily stock surge just because of still some concerns around that memory crunch.
So where are we in this memory cycle? Are we in another one, or has this cycle been broken? How long might all this last?
Yeah, usually we see these cycles when it comes to memory chip stocks, memory chips, which usually last about 3 to 4 years. But this time around, many say that it is a super cycle because something structurally has changed, and that is that shift away from capacity when it comes to these NAND and DRAM chips, but shifting towards the HBM chips that is required to build these AI-related infrastructure. So that's kind of the fundamental drivers there. But also, you've got these DRAM prices surging some 600% in the past few months. So there is still a lot of catch-up when it comes to how much it can weigh on the users of these chips. And for now, when we talk to fund managers, they are saying that valuation-wise, we are pricing in for about the supply tightness for the next 1 to 2 quarters, but they are expecting that tightness to actually go on for another 1 to 2 years, just because demand is not seeing any slowdown yet. So for now, it's likely to continue to weigh on stocks. So we're going to see further downside when it comes to the users of these memory chips.
Bloomberg Asia Equities reporter Winnie Su there. In fact, we'll have more on the great memory chip crunch of 2026 front and center in the next edition of Bloomberg Tech Asia. We'll break down the winners, the losers, and what it means for investors. Join us on Friday, February 27th, 8:30 a.m. Hong Kong.
In the meantime, it's time for some morning calls ahead of the Asia trading day. Deutsche Bank says the software and tech sectors pose one of the all-time greatest concentration risks to the speculative grade credit market. Analysts warn that a meaningful chunk of outstanding debt could sour broader sentiment if software defaults increase. The bank notes the sectors comprise as much as $681 billion of the junk-rated credit universe. Microsoft shares have been hit with their second downgrade in less than a week, with Melius Research citing concerns that AI could disrupt software stocks. They cut their rating to hold, pointing to rising capex and questions around co-pilot products. The moves highlight investor anxiety that AI may be a lasting headwind for software growth. Shery?
And Avril will be tracking the Korean market open coming up in just a few minutes. And you can see this chart, the stunning $1.7 trillion rally in the Kospi, still not necessarily being enough to close a valuation gap to global peers. For more, let's bring in Asia Equities reporter Sang-mi Cha. Sang-mi, this is a perennial so-called Korea discount, right? What are we seeing right now?
Yeah, that's correct. The metric that they look at oftentimes to gauge whether this discount, Korea discount, has been narrowed is the price to book ratio. And of course, when we look at and compare a year ago, it's now up to 1.7%, at 1.7 times. So on par with where China and Japan is right now. So comparing to when it was below 1, it has made some progress. But what the traders are saying is we're not factoring in the earnings outlet. So for Kospi, we're seeing over doubling of that earnings in 2026. And also when compared to Japan and China, where we're looking at 24%, 12% profits for some of their TOPIX and CSI members, that is a huge gap here that we're seeing. So when you consider and you factor in these profits for these companies within Kospi, they are saying that there is still this this Korea discount. Now, what the Korean government is trying to do is they're trying to move beyond eliminating Korea discount and go into actually Korea premium. So last week, they have actually rebranded this task force they had to reach Kospi 5000, and they have now given this new mission to eliminate Korea discount. So how do you do that is you actually need continuous corporate reforms, including cancellation of treasury shares, but also inheritance tax would be the ultimate test to whether the Korea discount can be eliminated. And that's because a lot of the chaebols, the family-run companies in Korea, are actually pushing down the share price because when it comes to succession, they will be able to pay a lot less if the share prices are down.
Sang-mi, when it comes to Korea, we're also watching how regulators are looking into a crypto exchange. What more do we know about that?
Yeah, so on Friday, 7 p.m., we have seen these so-called ghost Bitcoin be transferred to hundreds of users of Bithumb. This is a Korean crypto exchange. And what happened was it was supposed to be a promotional event, a thank you kind of payout for its users. It's to send about 2,001. That's about $1.4. And what really happened was actually the employee had a clerical error. Instead of putting in 600K1, it actually put in 600K Bitcoin instead. Now, the Bitcoin, the crypto exchange itself on its ledger did not have that much of Bitcoin. That's about $40 billion worth of Bitcoin that we're talking about. So what happened was it actually triggered panic sell, and it triggered about 18% drop within the exchange. So the regulators are now looking into what really happened.
Sang-mi, thank you for bringing us the latest. Our Asia equities reporter Sang-mi Cha in Hong Kong. We have more hit on the Asia trade. This is Bloomberg.
We're looking to a potentially positive open across Asia as we're seeing the ASX 200 already gaining ground, energy, materials leading the gains. Of course, we are seeing oil prices gaining ground. Not to mention gold is above 5,000 again. And you can see Nikkei futures popping more than 2%. We're already at record highs after the historic victory of Prime Minister Takaichi. She seemed to acknowledge the concerns among investors over her fiscal plan. So we'll continue to watch those developments. The market opens in Seoul and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens after another session of gains for the tech sector in the overnight session. Avril, we continue to see this AI spending, and Alphabet being one of the latest to tap the bond markets in order to finance all of this spending. We'll be watching those tech stocks in the Asian session as well.
Indeed, and as some of our colleagues have been highlighting, maybe don't read too much into the tech rally, given how they think this value rotation is still underway. You take a look at the breadth that was lacking overnight in terms of the Wall Street climb, Shery.
What's for certain is that we're seeing volatility in the tech sector, right? Especially with those software makers having seen that massive sell-off just a few days ago. Although we continue to see the likes of Oracle, for example, gaining ground in the U.S. session, we are watching those tech stocks in Japan as well. The Nikkei, of course, already at a record high after that historic landslide victory by Prime Minister Takaichi and her party. The Japanese yen under a little bit of pressure against the U.S. dollar, 156 is your level. But after seeing some strength in the previous session, which was pretty interesting, right? I mean, we have seen the resilience of the Japanese yen, especially on commentary coming from the chief currency official here in Japan, that the government is on high alert for potentially more weakness or just volatility in the currency space. Also, a little bit more resilience when it comes to the JGB space. We saw a little bit of downside pressure in the previous session, but given all of those fiscal concerns that we've had in this country, the declines were pretty modest. Take a look at how Korea is also coming online. We had a session of gains being led by, again, tech. The likes of Samsung, for example, surged after reports that they're ready to ship those HBM4 chips. You can see the Kospi now coming online with the Korean won sitting at that 14.59 level. We had a little bit of more pressure on the Korean won side of things given the dollar demand from local importers, according to our sources. You can see the Kospi gaining for a second consecutive session today, Avril.
Shery, we also have updates on the Singapore economy, the final numbers for the fourth quarter of last year in terms of economic growth coming in stronger than estimates, and of course the advanced estimate coming in at 6.9% for the fourth quarter of last year. And this is driven in large part by the strength in manufacturing that's been growing double digits. There's been solid demand for both pharmaceutical as well as AI-related products, and this is despite concerns about Trump's tariffs and the impact on the Singapore economy. So resilience you're seeing there, and enough for the Trade and Industry Ministry to also upgrade its forecast for this year from 1 to 3% for Singapore's growth to 2 to 4%. So as much as 4% growth expected for the Singapore economy. Sing dollar is hovering at that 126 level. Don't forget, this is among Asia's top performing currencies so far this year. Taking you to US assets as well, where yields continue edging lower. We, of course, have been seeing those concerns about the cracks in the labor market, perhaps underscored by comments from the NEC director, Kevin Hassett, expecting labor market softness in the next couple of months. We do have those US labor market numbers coming in later this week, including with inflation data as well. And aside from that, as we've been highlighting, of course, it's this rally overnight in the US. Futures looking a bit soft now. How durable is all this looking? Let's bring in Raj Singh, multi-asset portfolio manager at Principal Asset Management. Raj, good to see you. So I wonder what you make of the moves in the US overnight. How durable is all this, and how does the AI complex fare going forward?
Well, good morning. Thanks for having me. So I would say, just I want to step away from this day-to-day noise. So if you look at the longer term, we believe, I think the macro environment right now is quite conducive. The growth is looking good. You look in the US, you look in Asia, and then the fiscal policy is quite supportive. Monetary policy is accommodative. So some bouts of volatility and since the beginning of 2026. First, we saw back of the geopolitical stuff, and then on the JGB moves, and then now this whole AI skepticism coming in the market. So I would say it's a healthy cushions. People are asking what are going to be the return. But the way we are looking at it is basically the growth is good, so some of the cyclical values should be doing good. So some of the rotation is really healthy for the market here. And the AI theme, it is long-term in nature, and there's a lot of advancement in the technology is happening, which means the businesses have to work out their business model. So we have seen this. I would say it's a kind of a little bit of like AI fears to it. Is more about, is AI going to work too well? So is it going to cannibalize some of the existing businesses which are out there, like the softwares? We saw a big drawdown in the software. But from our perspective, it's a 5 to 10 year theme, and the tech is still going to drive a rally. The big mega caps are in a very, very good position. We saw their debt is getting absorbed pretty well. Their leverage ratios are quite conservative. So I think they are in a good position. But you want to diversify a little bit, and especially for next 6 to 12 months, the cyclical value like the Korea, some of the miners, banks, they make a lot of sense to combine with the large cap tech here.
You talk about AI credit. I wonder what are maybe some of the longer term risks that maybe investors are underappreciating. I mean, Alphabet seems to want to have 100-year bonds. I mean, when it's that far out, is it a bit of a stretch? How much should investors actually weigh all this out?
Yeah. So that's a great question and point. So when we look at the AI, actually the issuance, so from the hyperscalers before 2025, the average issuance was around, let's say, 25 to 28 billion dollars. But what has happened, basically, since September, you have seen this pickup, and they have issued more than 100 billion, which has been digested very, very well. And last couple of issuance from Oracle, from Alphabet, they show that there is still ample demand because these companies are still quite conservative. Now, as far as like 100-year bond is going, so when from a duration perspective, when you take a 30-year bond or you take a 100 years bond, it doesn't make a huge difference. But definitely, it just shows that there is confidence in the market, there is confidence in the hyperscalers' balance sheet right now, and probably if they come up with it, the market may absorb it. So 100 years is a long time, but definitely what I can say is that there is good appetite for this debt. Market is absorbing this quite well. There are a lot of concerns around it, but keep in mind that these are still a lot of companies are net cash companies.
Yeah, Raj, adding to Avril's point, you mentioned $100 billion of issuance. Morgan Stanley is putting this number at $400 billion this year. That's the estimate. When you have such a large issuance coming from hyperscalers, is there any risk in that they become such a dominant force in the IG space that you cannot necessarily reflect pure credit risk anymore?
Yeah. So that's a great point, Shery. Again, I would say that you have to be selective with credit. So what has happened right now that rising wave bring all the boats higher. So that what have you seen the credit. But going forward, as these companies issue more debt, they will displace some of the demand. But apart from the supply side, we have to look at the demand equation. The demand in credit is quite strong. Technicals have been quite strong, and the money is flowing there. And bear in mind, there are more than $7 trillion in money market sitting, and then as the bond yields come down, some of that will move into this credit side, especially in the high quality credit from here onwards.
Talking about that rally and resilience that we're seeing around the world, we are looking at MSCI Asia now touching a record high as well. When it comes to really some of that diversity and some of that breadth in the rally across the region, are we seeing a little bit more of it here than we are in the U.S.?
Yeah, so what we are seeing, like now you see like the tech story, the market is not, I would say, giving up on the tech story, but there's definitely some of the diversification in the tech story happening. So what do you see? There's a lot of extrapolation in terms of like how the business models will look like in, let's say, next 3 to 5 years. But Asia has been the biggest beneficiary of the AI capex. We know that these hyperscalers are going to spend like more than $600 billion. And out of that $600 billion, like around 75% is AI related. And out of that 75%, around 50 to 60% is related to your compute. And AI is sitting, Asia is sitting right at the heart of it, basically. So you look at the Korea, where it has done very well. We have been positive, and we still remain positive on Korea because despite being rally, the valuations are going down. The earnings are moving at a rapid pace there. Similarly, Taiwan, and then in China is doing its own tech innovation, and they're supporting the economy. They're trying to pivot away from the export-driven or investment-driven model to the consumption-driven model. And then India, which has been a big laggard. I mean, it's a good diversification play. I think it's been quite soft, given it doesn't benefit in the same way from the AI, but I think it provides still a good diversification to that AI trade.
Raj Singh, always good to see you, multi-asset portfolio manager at Principal Asset Management. We have more ahead on the Asia trade. This is Bloomberg.
We're talking about responsible, proactive fiscal policy, but the responsible part is crucial. Our policy is to secure market confidence by ensuring fiscal sustainability, by steadily reducing the debt-to-GDP ratio.
Japanese Prime Minister Takaichi speaking after her party's landslide lower house election win. Let's bring in our Japan politics and economics reporter Sakura Murakami. Sakura, so the Prime Minister seemed to sort of acknowledge the concerns in the markets about her fiscal plans.
Yeah, definitely. She said in her press conference yesterday that this was something that she was looking into, that she had received advice about, especially concerning the tax cut, the sales tax cut on food. So it seems like she's looking at markets, she's kind of gauging what the response is and also trying to build trust there as well.
When can we expect her to act?
Well, she did mention that she wants to compile a report on the possible sales tax cut. It'll be an interim one, but she wants to compile a report by early summer. So we can probably expect some sort of plan, something there. She did say that she has to talk to the opposition parties. She's kind of seeking a sort of consensus broadly in Parliament as well. So that might take some time, but we'll see something by the early summer.
Do we have any idea of how she plans to fund it? Because they continue to say they're not issuing new bonds.
Yeah, exactly. I mean, that's the big question that everyone's wondering about. And yeah, she's saying they won't be issuing new bonds. She did mention, and she has mentioned this before, but they'll be overhauling kind of government expenditure, mainly in subsidies and also tax exemptions. I think the concern is that she's kind of shown this or said this is an alternative form of funding, but we don't have any of the details. We don't really have the numbers and whether that's going to add up to, you know, a 5 trillion yen shortfall a year.
Yeah, more than $230 billion or $320 billion. Also concerns about Japan's relationship with China. Take a listen to what the Beijing Foreign Ministry had to say.
The election is the internal affair of Japan, but this election reflected some deep-seated and structural issues as well as certain emerging views, trends, and developments, which deserve serious examination by people with insights in Japan and the international community. The lessons of history are still fresh in memory and should not be left behind. We urge those running the Japanese government to take seriously, rather than brush aside, the concerns of the international community.
What can we expect in this relationship?
Yeah, China has asked for a retraction again, but Takaichi most probably won't do that. It'll make her look bad, and the Japanese government's stance is that a retraction isn't necessary. Japan's position on the matter, especially on Takaichi's comments on Taiwan, hasn't changed. So this stalemate seems like it's going to continue for a while yet, but with the huge electoral victory that Takaichi won, she's going to be around for a while. So there has to be some sort of off-ramp, possibly in the next year, maybe we're looking at, you know, not immediately, but it's going to... this isn't a problem that's going to go away anytime soon.
Yeah, and we're going to be watching that conversation that Prime Minister Takaichi will have with President Trump very soon as well. Bloomberg Japan politics and economics reporter Sakura Murakami as we await that White House visit, also Avril, on March 19th.
Absolutely, Shery. And against this geopolitical backdrop, it's interesting because Bloomberg has learned that Chinese regulators have advised financial institutions to rein in their holdings of US Treasuries, citing concerns over concentration risks and market volatility. Let's bring in our China correspondent, Mimin Lo. Mimin, what more do we know about the target scale, the timing of this move?
Yeah, the timing is certainly interesting, right? It comes in recent weeks. We understand from sources that the Chinese government regulators have been quietly and verbally telling some of its largest banks to start to reduce their positions on U.S. Treasuries, to reduce their purchases. And this really signals the ongoing concern around whether or not Treasuries is still the safe haven asset, especially given that the dollar over the past year, and particularly in January, has been depreciating. We have Donald Trump saying that he is comfortable with a weaker dollar. You have the Fed rate cuts on the way, and then concerns over mounting fiscal risk as well. So So that's led to the Chinese government really starting to ask its banks to reduce its positions. But bear in mind that this is not new, right? Because China has been reducing its positions in treasuries for over a decade, and we haven't seen a bear market in treasuries or panic selling. We did see yields lifting in the early morning session in the U.S., but then ended the day stabilized. So some analysts are saying that this is not new. It's a gradual strategic reduction of U.S. treasuries that the market shouldn't overread into it. Although other analysts are saying that this could potentially snowball and push U.S. Treasury yields higher in the longer term because nobody wants to end up holding the bag.
Yeah, to your point, China's holdings of U.S. Treasuries have fallen to a 2008 low or so. So will there be any impact on Chinese banks?
Yeah, so not quite significant, because if you look at China's top 4 lenders, their holdings of dollar-denominated bonds is about $370 billion. And that is in all just about 5% of their total bond holdings and just 1.5% of their total assets. So any de-risking is going to have quite an insignificant impact on China. But it's interesting what MLive is saying is that they forecast China will reduce their dollar assets to 40% of what it was in 2024 by 2050. And here you can see on this chart that as China reduces its U.S. Treasury holdings, there has been a growing demand from foreign buyers. That's a white line there that helped to offset the decline in the blue line, which is Chinese Treasury holdings. So that's why there hasn't been a huge impact so far. But at the same time, it's also reflective of the shifting structural changes in the global economy, right, in terms of the reduction in the U.S. share of the global GDP, reduction in U.S. dollar role in cross-border transactions for China as well, especially after the tariff war. China's exports to the U.S. had declined by 20% on year. So it makes sense that this is a long-term strategic shift to diversify their market assets.
Min Min, thank you for all the context. Bloomberg's China correspondent Min Min Lo. Now, we're also looking at assets in Europe at the time where we saw overnight a modest recovery when it came to US or UK assets, I should say. The political rumblings there, certainly something for investors to consider. The pound a bit softer against the greenback for the moment, although FTSE futures pointing to slight upside. UK Prime Minister Keir Starmer has received a show of support from cabinet members after the Labour Party's leader in Scotland urged him to quit. He's been under pressure for appointing Peter Mandelson as ambassador to Washington after disclosures about Mandelson's past links to Jeffrey Epstein. Let's bring in Bloomberg's Rosalind Matheson. Ros, so we are seeing him catching a bit of a reprieve. How durable do you think all this is going to be?
Well, certainly he does have that reprieve, and we saw Cabinet come out overnight and support him. But there's still a lot of questions about his leadership and a lot of questions about where the Labour Party is going. Of course, you know, it's only 18, 19 months since they won a very large victory, and yet their popularity has been eroding. There's been policy missteps. There's been questions around their economic management, their fiscal headroom. And so there's a lot of challenges for Labor to keep the momentum going. And does the Mandelson thing just continue to be a cloud over his leadership? And is there a sense that if they're going to change leaders, they should do it sooner rather than later to give a new leader time before the next election to set out their own stall for how they want to lead the country? But it does seem that they've decided now's not the right moment to do it. Certainly a bit of a rallying around Starmer flag event, you know. And Starmer did come out fighting, unusually for him, a bit feisty overnight, saying he's determined to stay on. Perhaps there's a bit of fire in him that people haven't seen in a while, and they like that. The question is, again, how long can this go on for? Because we've got local elections coming up in May, expecting Labor again to struggle in some of that and possibly struggle against, you know, Nigel Farage's far-right party as well, you know, getting some momentum. So there's a lot of challenges there. Do other potential leaders wait to see how May goes and then make a move?
And how are the British public viewing all this? Are they also perhaps running out of patience on the handling of the economy?
Well, certainly they view this as a distraction, and they want the government focusing on things, as you say, including the economy, the National Health Service, infrastructure, and so on. It's interesting because the economic data in the UK hasn't been terrible of late. You know, there are signs that retail sales are improving, home prices are starting to improve again, business sentiment is okay. The challenge is it's not filtering through to ordinary people in the UK. They don't feel better. So even though the data is sending one signal, they're not necessarily feeling more confident, and they don't have a lot of confidence, the surveys show, in the government to lead the economy. And that's really a narrative challenge for Starmer. And, you know, how do you get people to agree that life is actually better for them than they feel? And so he's got a lot of work there to do to show that the UK government's got policies, they've got strategies, and they're going to find a way to help, you know, people feel better.
So what exactly are the concrete policy moves that Starmer has on the table to sort of turn things around?
Well, certainly he's gotten, you know, a lot of countries are looking at things like AI. They want to, you know, get investment to come into the country for AI, for data centres. He's been trying to position the UK, amongst others. Alongside that, there's opportunities for the UK to get international students to come in who are no longer going to the US, so to really buffer their universities. But the problem is there's not a lot of money in the pot in the UK, so fiscally there's very little headroom for them. So they do need to spend to improve the National Health Service. They do need to spend on infrastructure to bring companies in, but they just don't have the money to do it.
Ross, good to get your insights. Thanks so much. Bloomberg's Rosalind Matheson for the latest out of the UK. And you can explore live streaming news and interviews, as well as Bloomberg TV shows, documentaries, reporter analysis, and more in one place. Check it out at bloomberg.com/videos. We have more ahead on the Asia trade. This is Bloomberg.
Here are the top global headlines that we're following. Bank of France Governor François Villeroy has announced he will step down in June, well before his term was due to end in October 2027. Villeroy says the decision is personal. It clears the way for President Emmanuel Macron to appoint his successor rather than leaving the choice to a future administration. A White House official says the exact date in April for President Trump to meet with Chinese leader Xi Jinping has not yet been finalized. That's after Politico reported Trump would head to Beijing to meet Xi in the first week of April. The two leaders could potentially meet 4 times this year as their trade truce holds. U.S. Secretary of State Marco Rubio has criticized a 20-year prison sentence for former Hong Kong media mogul Jimmy Lai. Rubio described the court decision as unjust and tragic and called for Hong Kong to grant Lai humanitarian parole. The 78-year-old was convicted of multiple breaches of the city's Beijing-imposed security laws, as well as British colonial-era sedition legislation. The U.S. is warning American-flagged ships to stay as far as possible from Iranian waters when navigating the Strait of Hormuz. In the Maritime Advisory, the U.S. says Iranian forces have attempted to force commercial vessels into their territorial waters as recently as February 3rd. The warning comes after diplomatic talks in Oman, described by both sides as positive, which is why you had oil prices under a little bit of pressure last week. But we have seen a jump in the overnight session after those concerns around the Strait of Hormuz. We have seen prices climb this year despite a looming supply glut. This is Bloomberg. Google's parent company Alphabet is going on a global bond spree, raising $20 billion to fuel the unprecedented spending plan behind its artificial intelligence push. Let's bring in global tech executive editor Peter Elstrom. Peter, great to have you in the region, joining us from Hong Kong today. But really, Alphabet even thinking about a 100-year bond sale. What's this about?
Well, it was just last week that we got these staggering capital spending plans from the big tech giants. First, it was Alphabet saying it could spend as much as $185 billion this year on this AI build-out that they are planning. Then Amazon the next day said that it could spend $200 billion on CapEx. So these are really staggering numbers. This is the most amount of money that any company has ever spent in terms of CapEx on something like this. But one of the big questions at the time was whether investors were going to be willing to give them the money to be able to make these investments. Both companies, of course, have a lot of cash, but they don't want to spend all that money out of their cash. So they went to the markets, and we got the answer today in Alphabet's case, and it was a resounding yes. Investors really want to invest. They went out expecting to raise $15 billion in USD. They got so much demand that they bumped that up to $20 billion. They're also going to issue their first instruments in British pounds and in Swiss francs also. So we're seeing the one that you were referring to in the 100-year bond is going to be in the UK. They're offering that 100-year bonds. You don't really see these really very often at all. It's usually by governments or sometimes universities. The University of Oxford has issued them in the past, but it's very rare to see those coming from companies. The last time we saw something like this, Motorola actually issued 100-year bonds in 1997. Believe it or not, I was covering Motorola in 1997, and you could not expect the future for that company that we've seen since then.
Yeah, it's had quite a fall from grace, so to speak. But can you help us reconcile as well when it comes to these hyperscalers or these big tech companies and how they're tapping the debt markets? How are they still able to do so and get pretty solid investor demand at a time where Max Evans, you take a look, it's down from the October highs, and then there are still these concerns about circular deals, circular financing?
Yeah, there's still some questions about whether these big AI investments are going to pay off. And we went through that last year. Certainly saw a bunch of these companies take a hit because of how aggressive their spending plans are. I think what you're seeing from at least these big 4 or 5 companies is that they're going to step up spending because they see this as a competition to lead in the AI race. Nobody wants to be left behind. We've seen this many times before in things like search and mobile operating systems and web browsers where one company tends to win. They tend to take the vast majority of the profits from that business. And you see Alphabet, Amazon, Microsoft, Meta, all of them are competing very aggressively. So they're going to make these investments now. They have the cash. They're able to go, as we saw today, they're able to go to the markets and raise this money through bonds also. They want to make these capital investments now in order to be able to win the race or at least compete very aggressively to try to win the AI race for these AI customers in the future.
Peter, to your point that you were covering Motorola back in the 90s, I'm just curious, did you guys see the dot-com bubble bursting? Did you see it coming? Because right now what we're really trying to do is trying to figure out what all of these deals mean, because this exuberance that we're seeing around artificial intelligence and all of the different signals that we're getting, is this just noise, or could it really forecast something more gloomy down the line?
Well, it is a good question. I mean, one of the reasons that companies tend not to issue bonds of this length is because investors are nervous about their future. And when you look at a couple of the cases that we're talking about, certainly Motorola, you have good reason to be nervous about their future. This was actually before the dot-com bubble burst. They were the leader in the mobile phone business at that time. They were by far the best competitor. They then faced competition, of course, from Nokia and BlackBerry and Apple. After that, lost. They got sold. They were not able to maintain their independence. Another company that's maybe a better example of the risks of these century bonds, as they call them, is JCPenney. JCPenney, the retailer, was very strong at one point in time. They went out, they raised money for 100 years, and they went bankrupt 23 months later. So I think that's a lesson for investors. Now, of course, we don't expect anything like that for Alphabet at this point. It's a company with a very strong business, growing very quickly, making these aggressive investments. But 100 years is a long time, so investors are taking on some risk here.
Peter Elstrom, always great to get your perspective, and it's really good to have you back in the region, joining us from Hong Kong. He's the global tech executive editor here at Bloomberg. Let's actually stay with tech because, of course, another variable right now in the tech sector has been the surge in memory chip prices over the past few months. That's opened a vast divide between winners and losers in the stock market. Asia Equities reporter Winnie Su joins us now from Hong Kong as well. So, Winnie, how are we seeing the dynamics play out in the markets?
Yeah, morning, Shery. I think just to Peter's point, it is that build out of AI and that spending in CAPEX that's really driving the demand in HBM, and hence you are seeing that shortage in the DRAM and also the NAND space. And that is really affecting markets right now because on one hand, you're seeing these memory chip users really struggling, and it's spanning across really the board with PC makers, smartphones, EVs, and also to gaming companies, you name it. And on the other hand, you're seeing memory chip makers, especially these small ones in Asia, for example, Kioxia, up some 1,000% in the past year, and along with some of these smaller Taiwanese names jumping some 3-folds, 4-folds on it. So it is a divergence, and we're seeing that divergence coming out even more as the ongoing earnings season unveil some of these struggles that these chip users are having. So you are seeing Nintendo, Sony, and also Qualcomm getting punished by revealing these struggles. So for now, we're likely to see a further pressure of these users.
What about this talk of the memory cycle? What are we seeing there?
Yeah, so traditionally, we are talking about memory cycles being quite cyclical, and you have these boom to bust cycles that last for about 3 to 4 years. But this time around, investors, fund managers actually telling us that the cycle what we're seeing right now is longer, and also the magnitude is bigger compared to some of these previous cycles. It is because of that structural shift into AI that we talked about just now. But that is really changing the landscape here, and hence you're seeing prices of DRAM, for example, going up some 600% in just the past few months, and that's not really what has been priced in so far. Yes, we are seeing the valuations being changed at this point, but it's for now just factoring some tightness in the next 1 or 2 quarters. But fund managers right now still reassessing, and we're expecting maybe that tightness to drag for another 1 to 2 years. So a bit of further recalibration around that area as well.
When China has always had its own ecosystem, what are we seeing in the tech sector there?
Yeah, so actually it is very interesting because we just talked about this whole memory crunch, and some say that this is actually going to benefit some of these memory makers in China. In fact, we've got some reports saying that Dell, ASUS, some of these PC makers are thinking about using these Chinese-made memory chips. But these companies are actually not listed, not so many of them listed in China just yet. That's why we're not seeing Chinese tech names actually benefiting from that memory dynamic that we're seeing right now. And on top of that, you have a lot of other pressure that's coming into play. We're talking about onshore stocks losing about 6% already for its tech sector since the January peak. And HS Tech actually entered bear market just last Friday. Global volatility in tech stocks, yes, but domestically, lack of catalyst. You don't have much going on when it comes to earnings push, the government stimulus, or even AI updates. So we're seeing some profit taking in the tech sector, but investors shifting into consumer space, especially ahead of a Chinese New Year when it comes to retail names, restaurants, and also airlines, all seeing a pickup in expectation for further spending during the holiday.
Bloomberg Asia equities reporter Winnie Su there. Great to have you with us. We'll continue to discuss the great memory chip crunch of 2026, front and center on the next edition of Bloomberg Tech Asia. We'll break down the winners, the losers, and what it means for investors. Join us for that on Friday, February 27th, 8:30 a.m. Hong Kong time.
Meantime, let's take a look at how Greater China futures are shaping up on a day where Asia's stock gauge is hitting those records, extending from what we saw a day ago. Of course, that was led by Japan, South Korea. For the moment, we are expecting those gains on the Hang Seng Tech, but you do wonder, given the preference for hardware, or that seems to be the support that's coming from Chinese authorities, the extent in which this rebound or extension can be durable. Shery?
Yeah, we'll be watching some of those energy-related stocks as well as we continue to watch the geopolitics around Iran. The U.S. now warning American flagged ships to stay as far as possible from Iranian waters when navigating the Strait of Hormuz. In a maritime advisory, the U.S. says Iranian forces have attempted to force commercial vessels into their territorial waters as recently as February 3rd. The warning comes after diplomatic talks in Oman, described by both sides as positive. Converse employees have been instructed to work from home ahead of layoffs and restructuring at the struggling Nike brand. A memo to staff from CEO Aaron Kane warns of difficult decisions but doesn't specify how many positions will be eliminated. Converse has struggled to break its reliance on its Chuck Taylor shoe, and revenue plunged 30% last quarter. Apollo Global Management has set a record in its lending business, putting it on track to become one of Wall Street's largest underwriters. The firm says it issued $97 billion in loans in the fourth quarter and more than $300 billion for the full year. Its capital solutions business saw fees surge 21% from the previous year, also setting a record.
Let's take a look at what we're seeing down under. Australian assets. You're seeing that tick up in the Australian benchmark. And this is, of course, an index that has been supported by the moves in material-related stocks. Banks also have been faring pretty well. A bit of a pullback on the Aussie dollar against the greenback after hitting those multi-year highs. It is also about the concerns surrounding the trajectory of the RBA, having made an awkward U-turn already last week with that rate hike. We also had data out of Australia, and coming up, those consensus expectations see Australian company profits rising about 9% through 2027, but rising rates and a stronger dollar are adding pressure. UBS equity strategist Richard Schellbach joins us next with their outlook. More ahead. This is Bloomberg. Australia's biggest companies heading into earnings season in an upbeat mood, with expectations for the ASX 200 back at their highest since the middle of 2023. And the materials sector has been driving things thanks to these stronger commodity signals. Although the end of the RBA's easing cycle could weigh on consumer-focused sectors, risks also remain from the strong Australian dollar and elevated valuations. Let's get more with UBS Australia equities strategist Richard Schellbach. Richard, it's good to see you. How optimistic are you viewing the upcoming earnings season?
Good morning. Look, we are relatively upbeat on this profit season in Australia. If you look at FY26 EPS growth for the Australian market, it now sits at about 12%. Now, 6 months ago, expectation from consensus analysts were for earnings to grow this financial year by only 3%. So we've certainly seen a big uptick in earnings growth expectations over the last few months. That's really been led by miners, but there is more to it than just the miners, because there is genuine underlying strength in the domestic economy, and that's ultimately why the RBA was forced to act last week.
What are the risks to that view, though? Because we did get the Westpac consumer confidence number. Sentiment is falling for a third straight month. How strong really is the underlying consumer sentiment, confidence, and what is that going to mean for consumer-facing stocks?
Look, there was the slippage in the Westpac sentiment measure that we just saw this morning, but we'd point out that it's certainly well above where it was 2 years ago and 3 years ago. And we'd also point out that this is a survey that has had a mixed sort of signal in terms of indicating the strength of the consumer. A few years ago, that sentiment measure was indicating that there was certainly going to be a collapse in consumer spending and a high likelihood of a recession. We saw neither of those. So the work that we've done in terms of surveying consumers in Australia remains near record highs. Ultimately, unemployment rate is low in Australia, 4.1%. There has been a return of wage growth over the last 2 years, broad-based economic data in Australia really started improving probably in about August and September last year. And although the RBA is now in a hiking mode, we need to remember this is ultimately a product of the fact that end demand remains pretty strong in Australia. And for that matter, the consumer stocks should be okay.
Given the tightening expectations from the RBA, we have seen the Aussie dollar also continuing to rally. Are we around 3-year highs at this point against the greenback? What does that mean for some of these companies, especially operating overseas?
Yeah, that's a good question. And look, it's a topic that's often misunderstood. The perception may be that a rising Aussie dollar is bad for Australian companies that generate earnings offshore. And from a pure currency translation point of view, that's true. But what we've found, and history tells you, is that when the Australian dollar's rising, it's a product of a strong underlying domestic economy and or a relatively strong global economy. It's also highly correlated with upward momentum in commodity markets. And what this altogether means is that periods of rising Aussie dollar are actually associated with outperformance from Australian stocks versus global stocks. So it's certainly a good environment right now for offshore investors to reallocate into Australia. I believe that they're underweight Australia and have been for quite some time. I expect that underweight to be narrowed. With respect to the sectors within the Australian market, all sectors in the Australian equity market from a price move point of view are correlated to an upward move in the Aussie dollar. The only sector that's not is the healthcare sector. So unequivocally, upward moves in the Aussie dollar are a confident story on the strength of the economy and the relative resilience in commodity markets. And they're both stories that we see staying for a little bit longer.
Which also means that perhaps cyclicals could outperform from here?
Yeah, we certainly are skewed towards cyclicals. And, you know, again, the measures that I mentioned indicate a cyclical tilt in your portfolio. And also, again, when we purely look at the economic data, PMIs above 50, earnings upgrades across the market, this is a cyclical type environment. Exacerbating the story right now is the shakeout that we're seeing in a lot of that defensive growth, tech, AI-related names. Now, they obviously were bid up, as were most quality equities over preceding years. That's now turned the other way, and therefore those sort of domestic cyclical stories, which Australia has so many of, and that are so detached from AI tech stories, really are not only the place with the economic and earnings momentum, but also a safe haven for investors to rotate into.
Richard, can you look at the minors for us? I mean, we've been seeing a number of prospective deals just fallen by the wayside, fallen through. What is this going to mean for the longer term growth of some of the Australia materials related companies at the time where maybe, you know, they need to secure supplies of copper, for example, or, you know, the idea that when it comes to the financial resources that have been plowed into these prospective deals, you know, a bit of that has been wasted?
Look, the mining equity space comprises about a quarter of the equity market cap in Australia. So it's always been key. And at the same time, for great periods of time, there have been concerns, often structural in nature, about how sustainable this space is. But it's powered on nevertheless. And as we speak right now, BHP is at a record high share price. Now, many of these mining companies obviously are pivoting to an extent with respect to which commodity they see as the driver of growth over the next 10 or 20 years. But, you know, taking a top-down view at the mining space in Australia right now, it's relatively healthy. And look, we need to remember that we are no longer talking about a China growth story of 8% per year. We're now looking at a China growth story maybe 4 or 5% per year. But what we have sensed over the last 3 to 6 months is at least a stabilisation in the Chinese economic story. When you overlap that with a decline in the US dollar index, that's supportive for commodity prices and ultimately is translated through to the strong outperformance you've seen from mining shares in the Australian market over the last 3 to 6 months.
Okay, so sounding very positive on Australia markets. Richard, great to have you. Thank you so much. Richard Schellbach is UBS Australia Equity Strategist. We have more on Australia ahead every Tuesday at 11:40 a.m. if you're watching in Sydney, 8:40 a.m. in Hong Kong. Plus, you can tune into the Bloomberg Australia podcast, which delves into the biggest stories shaping the country's role in global business. Find it on Apple, Spotify, or Bloomberg.com. We have more ahead on the Asia trade. This is Bloomberg.
People were asking, like, can we still trust? Like, what should we know and how should we think about where things are? Those are the sorts of things that will create rippling in the valuation of the dollar above and beyond what happens in specific markets. And we will have to, well, hopefully we don't lose that. I think it's been good for the U.S. to be the fiat currency for the globe.
Atlanta Fed President Raphael Bostic on confidence in the U.S. dollar. As we saw the greenback pressured in the last two sessions, losing about 1% on concerns over Chinese demand when it comes to U.S. Treasuries after Bloomberg reported that Chinese authorities had asked financial institutions to rein in Treasury holdings because of volatility. Right now, we're seeing a little bit of upside on the Bloomberg Dollar Index right now, but you can see right there that the MSCI emerging market currency is also holding steady, but after rallying against the greenback as well. Also, another pair that we're following, Euro, Japan, Yen, because that's really nearing those record highs. Of course, Avril, we are now again seeing some pressure on the Japanese currency.
Yeah, and given that pressure, you do wonder what that means for some of the export-related stocks in Japan, which yesterday, when the yen rebounded, were pretty hard hit. So looking at the Nikkei, you are seeing the tech stocks doing well. The banks are also helping to lift the gauge, which, of course, yesterday already closed at a record high, and that helped the MSCI Asia Pacific, the gauge for the region, also at the highest on record today. It looks like an extension of yesterday's moves. For the moment, the idea that among some of these hyperscalers in the U.S., they're still spending big. That's fueling demand for chip-related stocks in the region. SK Hynix, Samsung Electronics, also in the green today. Shery.
Yeah, and let's not forget that also we're on earnings watch. So do watch out for our results out of Honda, out of Japan. We do have Nissan later in the week as well. That's it from the Asia trade. Our markets coverage continues. The China show is next. This is Bloomberg.